we see year. At present, there is an investment. The current market value is given. Then for 1 to 7 years, okay, you can also write it as 1, 2, 3, 4, 5, 6, 7. But simplifying the calculation, it is 1 to 7 years. After that, we see the last 7th year, the redeemed value is there. Now, what are the cash flows? If we are talking about cash flows, the present value, it is a negative figure 107.14. Okay, the interest amount we have already calculated it to be as 5.6. Then we have the redeemed value, the value which is redeemable at the end of 7th year is 107. So we have to assume some rate, present value at let's take some, we can start with anything. Okay, 5%. Generally we start with 5%, 10%. So we start at some level, and then accordingly we make the adjustment. So if the present value at 5% is taken, this one, the annuity factor of 5% from 1 to 7 years is how much? Can you look into the table values and tell me?
Yes, ma'am. Give us a minute.
Sure, sure.
5.786.
5.78.
6.
786. Okay, done. 5.786. Then 7th year, it is not an annuity, it is only one, because maturity value is only one time at the end of 7th year. So what is it? Present value interest factor at 5% in the 7th year. Is equal to 1 divided by 1 plus 7%. Is it 0.9345? No, what did I do? Not 5%. Okay, is this the value?
Yes, ma'am.
Okay. Then present value, multiply this into add them up and see, it is a negative figure. We are getting a negative figure, but we should get exactly equal to 0. So if we are not getting exactly equal to 0, then we have to change the discount rate, because we've assumed at 5%. We have discounted it more than um, the uh, the investment amount, or the 0 year, the present value of it is 107. But when we have discounted the cash inflows, they are more than 107. That's why we are getting it as a negative bar. No, we have discounted more. Therefore, the cash outflow is greater than the cash inflow. So now what we have to adopt is, we have to adopt the strategy of changing the discount rate, which is less than that. Okay, we need not discount it as much as um, at 5%, but little less. So assume a rate present value at 4%. So this would be one. Please check this one and then tell me. This one you tell me.
6.002.
6.00. Okay, so now we got it as a positive figure. One is a negative figure, one is a positive figure. I hope you remember how do we calculate IRR. So this can be taken as an example for calculating IRR also. So one figure is, we got it less than the 0. That is uh, after we discount it, if the value, the NPV value comes out to be as 0, then that is the rate of IRR. That is the value of IRR. Here also, since we do not know at what rate we have to discount these cash flows, so we are trying to find out what is R. R is calculated in this particular fashion, wherein we are taking the all the cash flows and then trying to find out what is R. So now, to calculate what is cost of debt with the model of IRR, we are mentioning it as after tax, because remember, interest was calculated as after tax. So the tax part of it is applied here. 1 minus 20% is applied. So if we have to calculate now what is after tax cost of debt, is equal to the trial and error method which we have used for IRR. The same thing has to be used. What is the formula? We take the lower rate. Okay, lower rate plus, in bracket we have NPV at lower rate divided by difference in NPVs at two rates. Both the rates, take the NPV. Okay, so that is in the denominator. Close the bracket. This into, we have the difference in rates. Of course, difference in rates is equal to only one, difference in rates. So this is the formula of interpolation with IRR. So now we see that lower rate is between 5 and 4%. The lower rate is 4%. 4% plus um, NPV at the lower rate is 2.462. So 2.46, or you can take it as 4 digits also, um, divided by one figure is minus point minus 3.6, another figure is 2.4. So if we are finding out the difference, we should not be taking the sign, because it's delta is used in this formula. So we are not supposed to use the negative sign, but we just have to find out the difference. So if we are finding out the difference, let's look into this one. If we have to find out this minus, so if you are finding out the difference is equal to this minus this. So whatever we have, that is, but without the negative figure. You can also try it the other way around. That is this minus this. But basically we are finding out the difference. Only one thing what we have to remember is we are not supposed to take the negative sign. It is only the difference between these two things without the delta part of it, without the negative sign. Um, Divided by 6.13. Okay, close this. Then we have into the entire thing into a difference in the signs, that is 5% minus 4%. Just calculate that and tell me what is the value which is equal to 4% plus. We have 2.46 divided by 6.13. Is this correct? 4.44. No, no. We also have to multiply into 1% into 1%. Okay. The difference in the rates. So now cost of debt capital is at 4 point, no, R is at 4.4%. So when we have calculated, we got this to be as 4.4%. At what rate when they are discounted? The discounted cash flows, the future cash flows, they equal to the present value which is 107.14. So that is the logic. Now when we use the cost of debt equation also, how do we find out what is the present value? The present value is based on the future expected future cash flows. That's the logic there. Okay, so now we got it to be as 4.4%. Can you tell me what is the market value? Market value is equal to the current market value of each bond is 107.14. So for all the 14 million bonds, how much would it be? Okay, that is the point here. I'm dragging it down so that we can check that and give it. Market value will be 14 million into 107.14. So which is equal to, this is weight of debt, is equal to 14 into 107.14. Can we find out what is weighted average cost of capital? We can take the two types of capital, equity, then take debt. Okay. Then take the cost of capital, K. K per equity, we got it as 10.3, 10.3%. Then debt, we got it as 4.4%. Okay. Then we have to also take the weights of weights are for equity capital weight is 75 million. For debt capital, okay, please look into this one. The bonds have a total, this is total nominal value of 14 million. Total nominal value is 14 million. So how many shares are there? I just took it as 14 million. These are not, how many bonds are there? These are not bonds. This is the total value of bonds, which is $14 million. These are not 14 million bonds. So how many bonds are there? Total 14 million divided by each bond is worth 100. The value $14 million divided by $100 gives us the number of bonds. Fine. So here it should be divided by 100. So we see that this is roughly 14.99 or it is 15 million. Then multiply W into K. It says WACC is equal to total cost divided by total capital. So total cost is 8.385 divided by 90 is equal to 9.32%. Anyone else join? No, only you two. To continue further, okay, the equity beta of Fence company is 0.9 and the company has issued, these details are given. Then we also have the bond details. So we calculated what is the weighted average cost of capital, which is for 7 marks. Then comes to the second part of it. Calculate a cost of equity which could be used in appraising the new project. So in this case, we have certain other investment details also given here. Fence company, second paragraph, pay attention. Fence company plans to invest in a project that is different to its existing business operations and has identified a company in the same business area as the project. Hex company as the project Hex company. The equity beta of Hex company is 1.2 and the company has an equity market value of 54 million. The market value of the debt of Hex company is 12 million. The risk-free rate of return and these things are given. We are asked to calculate what is the cost of equity which could be used in appraising the new project. Cost of equity which could be used in appraising the project. Okay. So generally when we are looking at an investment proposal, in case of investment proposal to calculate the cost of equity, we generally do not adopt the dividend model because dividend model is applicable only for a particular company, because what is the dividend paid, what is the growth rate applicable for that company, the price of that particular company is taken. Here now we are looking at the investment proposal which has to be invested in the market. Then relatively there is another company, X company is all the data is also taken, and we are given about the beta aspect, the return from the market, those aspects are given to us. So here the cost of equity will not be based on dividend growth model, but it will be based on CAPM model. Okay. If it is CAPM model, okay, if it is CAPM model, what's the formula? The formula is risk-free return. Uh, Risk-free return plus beta into RM minus RF. This is the formula what we have used. So the details here for this particular company. Fence company plans to invest in a project that is different to its existing business operations and has identified a company in the same business area as the project Hex company. The equity beta. So it says that the equity beta very specifically mentioned as equity beta. Now, equity beta of Hex company is 1.2. Okay. And the company has an equity market value of 54 million. These are the details which are given. The market value of debt of Hex company is 12 million. So the market value of debt is 12 million, equity value is 54 million. So now what do? We have to multiply it. The beta part of it has to be calculated as weighted average beta. So weighted average beta. So we see that beta of one thing is given as 1.2. Equity beta is given as 1.2. So then calculate the weighted average part of it. So 54 is the market value, and then debt part of it is 12 million. So in that case, we need to take the weighted average part of it. So take 1.2 into the market value, okay, divided by the total value, the total uh, debt part of it. The total debt part of it has to be taken into consideration. So just a minute.